This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Firing on all cylinders, the economy goes from a crawl to a gallop, growing at its fastest pace in 2 years thanks to a ramp up in consumer spending. Can the momentum continue, and what does it mean for your money?
Sign-up surge. President Obama says 500,000 people signed up for health insurance on the federal exchange in the first 3 weeks of December. But there are still many challenges.
Market Monitor, our guest tonight, has a list of stocks that she says will rise 15% or more in the new year, and their names you probably already know. All that and more tonight on Nightly Business Report for Friday, December the 20th. And we bid you good evening, everybody. I'm Bill Griffith, in tonight for Tyler Matheson.
Nice to have you here, Bill.
Here.
I'm Susie Garrett. Good evening from me as well. Well, the economy is looking pretty good, and the strong numbers out today surprised just about everyone. Gross domestic product, this is the sum of all the goods and services made in the U.S. during the third quarter. It rose a better than forecast 4.1%. That's the fastest pace in nearly 2 years. And the economy got a big boost not only from higher consumer spending, but business spending as well. The improving economy was one bright spot President Obama could rave about in his end-of-the-year news conference at the White House today.
As we head into next year with an economy that's stronger than it was when we started the year, more Americans are finding work and experiencing the pride of a paycheck. Our businesses are positioned for new growth and new jobs, and I firmly believe that 2014 can be a breakthrough year for America.
Well, some breakthroughs on Wall Street as well today. The major averages wrapped up one of their best weeks of the year with new all-time highs in the Dow and the S&P. Now, even though stocks sold off a bit into the close, the Dow Transports and the Russell 2000 also closed at record highs. Here's a look at the numbers. The Dow rose 42 points, the Nasdaq was up 46, and the S&P added 9 points.
Joining us right now to talk more about today's strong GDP report and what it says about the overall economy and the health of that economy right now. Lindsay Piegza is chief economist at Sterne Agee. Good to see you again, Lindsay.
Thanks for having me.
Is this growth sustainable, do you think?
Well, you know, 3.6% third quarter GDP was moderately strong. At 4.1, it's downright impressive. And even the combination of growth was much more balanced in this second revision. As we see consumption, the key to the economy was actually revised up from 1.4 to 2%. But the problem is, even at 2%, this is really a far cry from the gangbuster levels that we'd like to see, and would like to suggest that we will see above 2% growth as we head into 2014.
All right, but let's just say, Lindsay, that this momentum keeps going into the fourth quarter, into the first quarter of next year. What does that mean for interest rates? Will we see them going higher faster than we expected, maybe?
Well, you know, for the first part of the question, are we going to see the momentum carry over into the fourth quarter? Because remember, still a third of the growth that we saw in the third quarter was inventory rebuilding. So as retailers, as businesses struggle to eat through that inventory in the fourth quarter, that will actually contract from what we see in terms of growth at the end of 2013. Now, going into 2014, again, I suspect that given the tepid pace of labor market recovery, we have seen the quantity of jobs increase, but the quality of jobs have kept wages very benign at this point. And that will keep growth at a very slow but positive pace and keep interest rates under control.
And of course, this was the week the Fed announced they would begin tapering the quantitative easing program in January. I guess good timing, huh?
Well, you know, what we saw in the third quarter GDP report was actually very much in line with the Fed's assessment of what we're seeing in the broader economy. The economy is on firmer footing, but it's not on strong enough footing to suggest that the Fed can begin to remove accommodation at a very robust pace. This was a very minimal reduction in monthly bond purchases to the tune of $10 billion. And again, during the press conference, Chairman Bernanke was very clear that this should not be seen as a step away from accommodation, and in fact pledging that they will keep rates at a very accommodative level well through 2014 and well through that threshold of 6.5% on the unemployment rate.
All right, so if you're a home buyer, let's say, and you have to go get a mortgage, should you feel relaxed about how things are going to look the next couple of months based on what Ben Bernanke is saying and also, what your forecast is on interest rates?
I certainly think so, although it's very likely that we do see a very slow, tepid increase in rates over the next several years. The idea that rates are going to shoot to the moon overnight really doesn't jive with the weakness that we're seeing in the underlying fundamentals of the economy.
And the other shoe, of course, the jobs growth. You mentioned that. That's something that's job one for the Federal Reserve right now. With the kind of growth we're seeing here, is that the kind of growth that will promote more job growth in 2014?
I certainly hope so, but we're not seeing it as of yet. Now, of course, October, November, these were back-to-back plus 200,000 non-farm payroll reports. But if you think back before the recession, the bar of expectations was well above 200,000. We were looking for 300, 400,000 on a monthly basis. So first of all, the bar of expectations has been lowered so precipitously. Second of all, if we take a longer-term view and look at the average growth rate over 6 months, we're at 180,000. That's the very same growth rate that we were at back in January. So despite the fact that we're 11 months forward and we saw discernible weakness in the middle part of the year, we're no better off than we were in January.
Lindsay Piegza, Chief Economist at Sterne Agee. Good to see you. Thank you for joining us tonight.
Thanks so much for having me.
You bet. Speaking of jobs, there was more good news on the economy today with the Labor Department saying unemployment rates fell or were unchanged in all 50 states in November. Employers added jobs in 45 of the states and in the District of Columbia. Nevada had the highest jobless rate at 9%. North Dakota has the lowest, thanks to all those Bakken Shield energy jobs. North Dakota's unemployment rate right now is just 2.6%. California, Texas, and Indiana reported the largest job growth in the month of November.
One person who's going to have to wait to get a new job is Janet Yellen. The Senate voted today to move forward with her nomination to become the next chair of the Federal Reserve. But for the final confirmation vote, Yellen, currently vice chair of the central bank, will have to wait until January 6th. That's when the Senate returns from its holiday break. Meanwhile, another embattled government entity, the Affordable Care Act, just reported a big surge in signups. President Obama told reporters at that same White House news conference that 500,000 more Americans enrolled in a new plan on the healthcare.gov website over the first 3 weeks of December.
I now have a couple million people, maybe more, who are going to have health care on January 1st. And that is a big deal. That's why I ran for this office.
But that good news came after the government website was shut down again today for about 3 hours. And there was another policy change for people who had their current plans canceled. Bertha Coombe joins us now with more on all of today's healthcare developments.
Which there were many.
Yeah, a lot of developments. It's very interesting because, the health department often holds those numbers close to the vest. They say, there are always discrepancies. We only report them once a month. And yet here the president comes out and makes news and says, we've had 500,000 on healthcare.gov. It is a big deal, certainly a big improvement for what we've seen from the first 2 months. But when you break it down, that amounts to about 24,000 people a day on healthcare.gov.
Is that good or bad?
For 36 states. California, in the last couple of days, has seen over 20,000 people a day on their website alone. So comparatively, way better than they've been doing, but they are far behind on the sort of projections that they had expected. They had expected by the end of December to have over 3 million people have bought health plans through the exchanges.
And in the meantime, a big deadline looms.
Big deadline looms on Monday. If you want coverage starting on December 1st, or rather January 1st, you have to sign up by midnight on Monday. Now, with the website having some glitchy problems, clearly there's a lot of volume on there. So if you are a procrastinator, you really shouldn't wait until the very last minute if you want to make sure.
Do I go Christmas shopping or do I sign up on healthcare.gov?
Exactly. Well, sign up on healthcare.gov after you've done Christmas shopping in the middle of the night when it's likely to be a lot quieter, actually.
The one thing that we keep hearing, the rules are changing. The words you always use when you talk to us about this healthcare thing, it's complicated.
Right.
And a lot of people we're hearing anecdotally are saying, I'm just not going to deal with all this. I've had problems signing on, and they're opting out.
There are some people who are opting out for now. That's right. And I think that's one of the concerns, that really this is the big surge for people who want to make sure they have coverage on January 1st. The next surge we're likely to see is at the end of March, when the open enrollment ends for the 6 months. But it's this time in between they're going to have a challenge to continue to engage people and to get them to continue to sign up.
Very quickly, we alluded to it. They changed the rule for those who did lose had their policies canceled and couldn't afford what the alternative was. There is now a bare bones policy that's available.
Exactly. There is within the law what's called an exemption that people get, a hardship exemption. And so they're giving people whose plans were canceled and they've not been able to find an affordable plan to replace it, a hardship exemption, so they won't be subject to the penalty. Of course, you have to fill out more paperwork in order to get that. And if they want, they can buy these bare bones plans that are only really offered to people under 30. But if that's the only thing you can afford, they'll let you buy into that.
Bertha Coombs, always doing a great job covering it. Thank you.
Thanks.
See you later. Still ahead, BlackBerry still bleeding money and customers, but the CEO has a plan and a new vision. The question now is, will it work?
Verizon and now AT&T both say they're coming clean, but the U.S. government might not be happy about it. The telecom giants announced that starting early next year, they'll publish semi-annual reports on customer surveillance requests that they get from Washington's top spying group, the National Security Agency, or NSA. Until now, most telecom companies have kept that information private, but they've been pressured by shareholders and privacy advocates to make those government requests public.
Well, lots of transparency at BlackBerry, maybe too much. The smartphone pioneer reported another massive loss last quarter, $4.4 billion, as it continues to struggle to win back lost customers and cut costs at the same time. But the company's new CEO says he can turn things around. So what does BlackBerry have in store? John Fort has our story tonight.
Times are tough at BlackBerry, but hopes are still high. New CEO John Chen delivered bad earnings news today with a big shortfall in phone sales. But he also said the company is going to take its medicine, booking a big loss on unsold inventory and outsourcing future manufacturing and design work to Foxconn to minimize future losses. And that sent the stock soaring after the earnings call. So the question, can BlackBerry survive?
The key to this is, BlackBerry's likely going to be a much smaller company under John Chen's leadership. Yes, the markets that they're serving in the enterprise customer, that is a valid market. We can see if they can grow and have a success there, but it's a much smaller market than what they were chasing after originally. But again, they have to play to their strengths, and this is what's left for them.
Unlike his predecessors, Chen isn't holding out hope that new BlackBerry phones will catch Apple and Samsung in the consumer marketplace anytime soon. Instead, he told me in an exclusive interview, he's looking to contain the handset losses while focusing more on BlackBerry's enterprise security and device management business.
Best way to do is to also offer end-to-end security solution in communication and productivity that is mobile-based. And so that's where we're going to be, at least for the foreseeable future, in the next couple of years. I think we had some issues with the handset business in terms of the consumer world. But the enterprise still love us. So that's where I'm going to focus in on.
The key will be for Chen to convince enterprise customers that BlackBerry is here to stay. So they'll hold on to BlackBerry server software and maybe buy more. For Nightly Business Report, I'm John Fort in Waterloo, Ontario.
Boeing won a big airplane order today, and that's where we begin tonight's market focus. Cathay Pacific Airways is paying $7.5 billion for 21 Boeing 777X jets. Cathay is the fifth customer, to order the newest version of the jumbo jet. Shares of Boeing rose 1% to $136.67. Quarterly earnings at Walgreens soared 68% as investments paid off, but more promotions and a slowdown in new generic drugs pinched profits. Still, the drugstore chain's results were in line with estimates, and investors liked the news. Shares jumped more than 3.5% to $59.04. But shares of CarMax tumbled after the used car seller posted an earnings miss. The company did see profits increase by 12% on growth in the number of used cars sold and on financing income. Still, the stock lost more than 9% to $48 and change.
And Navistar also saw its shares fall today on earnings. The truck and engine maker posted a wider than expected loss as revenue dipped on weakness in all of its business units. Company's been struggling since its engine emission technology failed to comply with environmental rules. That stock was down almost 6% today, closed at $37.16. And Oracle announced it's going to buy software maker Responsys for about $1.5 billion. Responsys helps brands market online through email, mobile, and social ads. This move is a sign that Oracle is strengthening its cloud unit right now. Shares of Oracle slightly off at $36.37, while shares of Responsys soared by 40%, closed at $27.40. And DealerTrack Technologies is going to purchase privately held Dealer.com. They make software for the car dealership industry. It's an agreement worth about $1 billion. DealerTrack helps connect car dealers with lenders and credit rating agencies. The company hopes the acquisition of Dealer.com will expand its offerings to car sellers. Wonder what they'll call a combined entity. Shares surged 12.5% to close at $48.19.
Our market monitor guest predicts 2014 will move toward a, quote, more normal market and interest rate environment. Janelle Nelson is portfolio analyst at RBC Wealth Management. Janelle, nice to have you back on the program.
Great to be here. Thanks, Susie.
So let's talk about what's normal and what's changed that makes you see 2014 as a more normal market environment.
Well, I think what's changed is since the financial crisis in 08 and 09, it's been a risk-off, risk-on market. It's been, is the Fed easing? Are they going to do more quantitative easing? And now we're back to a point where the Fed's beginning to taper. Growth is coming back to the U.S. and the rest of the world. And I think that you're seeing stocks respond to earnings, and stock picking once again, I think, will be a good thing to have in the marketplace.
What kind of stocks? What's the theme you're looking at? I mean, do you go with what we would call an early cycle group of stocks that usually do well as the economy begins to strengthen, or late cycle? I mean, where are we right now, do you think?
I think we're probably in the third or fourth inning of a 9-inning game. So we have plenty of room to move. So much has moved in 2013. This market was stronger than anyone really would have anticipated. That what I'm looking at for 2014 are stocks that are global in nature. I like blue chips that have lost their luster. Ideally, I like a few names that are trading below the peer group, and if they are steady dividend payers and or share repurchase candidates, even better.
Okay, and let's go down some of the stocks. And you have Coca-Cola at the top of your list, which sounds like it fits some of those criteria you just told us about. Tell us why you like it, because here's a stock that's pretty much trading where it was a year ago.
Exactly, and I think if you're in Coca-Cola or you've looked at Coca-Cola, you can look at the sugar tax in Mexico, you look at the cold weather, you look at the lower than average sales. It's not been a great year for Coke. China and Brazil have been weak, but we think a number of those considerations are going to turn in 2014. We see a rebound in both China and Brazil. GDP trends are trending higher. We also think that volume growth will improve. What drives consumption of soda more often than not is weather. We've had cold, rainy weather the first half of 2013, and I think that if we even get back to normal, I think that helps. So if you see a rebound in volumes for soda overall, typically Coca-Cola does better than average.
Coach fits the area as well. They've had a tough year. Their CEO is retiring early next year. A lot of competition from a Michael Kors and companies like that. Why do you like Coach here?
I think it's a global luxury brand that has not lost its cachet. I think the magic is a little worn, but it's coming back. I'm very excited about their Burrow brand, which gives you a first glimpse at what the turnaround could be on the creative side in the second half of 2014. In addition to that, you have a stock with a steady repurchase plan, a 2.4% dividend yield that's trading a full 4 multiple points below its luxury brand peer group.
Okay.
A lot of that bad news is built in.
We have half a minute left. Can you squeeze in a quick pitch about why you like Royal Dutch Shell B shares?
Absolutely. What worked in big energy in 2013 was restructuring. We think that's happening in Royal Dutch Shell in 2014. 5% yield while you wait, $7 billion of divestitures. We think the stock works.
Okay, great. Thanks so much. Any disclosures, Janelle?
Yes, actually, my company makes a market in all three stocks. Both Royal Dutch and Coca-Cola are clients of the firm, and a member of my household owns Coca-Cola.
Okay. Thanks so much for coming on the program. Have a happy holiday. Hope to see you in the new year.
Thanks, Susie. You too.
Janelle Nelson, she's portfolio analyst at RBC Wealth Management.
More now on that bipartisan federal budget that President Obama is expected to sign into law. The bill includes a new tool in the fight against identity theft. It limits access to a government database that some say has turned into a treasure trove for crooks. Scott Cohn has our story.
Terry and Stephanie McClung thought it couldn't possibly get any worse. Still mourning the death of their 5-month-old daughter, Caitlin, from sudden infant death syndrome, they filed their tax return claiming her as a dependent. But the IRS rejected the return.
Well, the email did say that someone else had already claimed your dependent.
Using Caitlin's Social Security number.
And it was the very last time we had to claim her, as our own, and somebody robbed us of that as well.
All it takes is a name and a Social Security number to file a tax return and collect a refund. And the Treasury estimates the IRS issued $3.6 billion in fraudulent refunds last year alone. The McClungs think the thieves got Caitlin's information from a government database that was set up in part to prevent fraud. The Social Security Administration Death Master File is exactly what the name suggests, a list of more than 85 million names and Social Security numbers, every death reported since 1936. Genealogists use it, investigators use it, so do insurance companies verifying a death. But a quick-thinking identity thief can use it too, which the McClungs think is what happened to them. Terry McClung testified before the Senate Finance Committee.
In mere seconds, anybody in the world can access Social Security numbers and other personal information for anyone in their database.
Now that's about to change. Included in the new budget deal, new limits on access to the file. Users will have to be certified. Fees will go up, and so will penalties for fraud. But some warn of unintended consequences. Background checks that won't happen, research that won't get done. Melinda Lutz-Byrne is a leading genealogist.
The real issue here is to get the IRS to use the Death Master File the way it was intended and to check before issuing refunds to people who really don't deserve them.
The IRS has been tightening security, but government audits as recently as this year say more work needs to be done. Even proponents admit the new law will make only a small dent, but the McClungs say it gives them a tiny bit of closure. Scott Cohn, Nightly Business Report.
Coming up on the program, activist investors were the biggest threat to corporate boards this year. So will companies embrace them in 2014 or push back? An update to a story we told you about yesterday. Following the credit card breach at Target, the CEO tonight is extending an apology to customers and offering a 10% discount on items purchased in store this weekend.
Well, this past year, more corporate boards chose to make room at their directors' tables for activist investors rather than getting mixed up in a public brawl. Mary Thompson now takes a look at why some of these boards are increasingly embracing congeniality with those investors instead of engaging in combat.
For tech giant Microsoft, its size offers no protection from a proxy fight. So instead of battling the activists' Value Act and risk their own jobs, directors gave the hedge fund a seat at their table, ensuring public peace during proxy season.
They can voice their dissatisfaction at the ballot box. And it's better to preemptively be speaking with your shareholders to understand what they have to say.
Increasingly, other shareholders listen to the activists' complaints, their support helping activists to win or be given a board seat by a company in 66% of the proxy fights they waged this year, according to the proxy governance firm ISS. No longer viewed commonly as rabble-rousers or corporate raiders, activist support among big institutional investors, like the California Public Pension Fund CalPERS, is growing, as they realize not all activists want a quick change and a quick gain, but many are focusing instead on long-term returns. Adding to activist power, their big war chest. They manage a hefty $89 billion in assets.
Board advisor Claudia Allen says their money and increased support from other investors is helping to change boards' attitudes about activists. Directors are engaging them more frequently and in a friendlier manner.
I think that type of outreach is trickling down to more companies. And again, it's with a view toward proactively understanding what the shareholder concerns may be and then figuring out what the board believes is an appropriate response.
Still, not all boards are open to the new openness to activists. PwC's annual director survey found that 30% did see more engagement with big stakeholders, but a third of those directors say they shouldn't be communicating with them. A strategy that could prove dangerous for those directors, given activists' growing financial and reputational clout. For Nightly Business Report, I'm Mary Thompson.
And finally tonight, Christmas came a little early for a 25-year-old Pennsylvania man, Jeffrey Ganano, who works at his family's fire sprinkler business, bought a $138 raffle ticket to a charity that preserves historic sites. He won the grand prize. And what was it? An original Picasso from 1914 worth $1 million. And Ganano doesn't know what he's going to do with it, but he says he has to find out how much the taxes are on it.
I'll give you a little clue, Jeffrey. Hang it up on your wall and be very happy with it.
$1 million Picasso. That's Nightly Business Report for us. I'm Susie Garrow. Have a great weekend.
I'm Bill Griffith. Have a great weekend, everybody. We'll see you on Monday.
Nightly Business Report has been brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. The economy's looking a lot better than expected. It grew more than 4% during the summer. That's the fastest pace in nearly 2 years, getting a big boost from higher consumer and business spending. That helped the stock market wrap up one of the best weeks of the year, with new all-time highs in the Dow and the S&P. The Dow rose 42 points, the Nasdaq was up 46, and the S&P added 9 points. Unemployment rates fell or remained unchanged in all 50 states in November. Nevada has the highest jobless rate, 9%, and North Dakota the lowest at just 2.5%. And in the first 3 weeks of December, 500,000 more Americans enrolled in a new plan on the government's healthcare.gov website. Be sure to tune into Nightly Business Report right here on your public television station.